So standard costing can be used in a flexible budgeting system to determine favorable and unfavorable variances. We need standard costing in a flexible budgeting system, which is one of the reasons it makes flexible budgeting more complex. So these are preset costs for delivering products, materials, established personnel costs, expected time levels, and expected levels of performance for creating products, and expected input levels. Memorize this sheet, this tab right here. These are what we really care about. So if we're worried about direct materials, there's really two buckets that can go wrong: the price or the quantity used in this class. Of course, we could worry about quality too, but that's for a future class. Direct labor, we can look at rate. Are we paying more than expected, or are they taking more time than expected? You can see this is really price, right? This is really like rate and price of the product, and this is really efficiency. We're trying to break it out into. That's what I want you to think. Either could go wrong, and then we can dive into efficiency. And efficiency is a product of quality, but quality is a little more complex than that. And then variable overhead, rate. Did the cost of electricity go up, or are we using more electricity per product? That's all we're trying to break it out into. But we need to understand those variances to fix it. So imagine this. What if we saw that our direct materials, we had a direct materials variance, but then you decided, oh, we must have a price problem. Without investigating it, we must have a price problem. So I'm going to go and negotiate with all my suppliers. And their suppliers say, we're giving you the lowest price in the industry. You get in fights with them and you lose some top suppliers. Because it turns out it's actually your workers are using too much, or you set your standards incorrectly, right? That's why we need to break this out. Or it could be vice versa, right? What if we tell our workers, you need to double your workload because your quantity is not meeting our standards, and our price is too high, but it turns out it's a price issue. And now you lose a bunch of your workers because the expectation is too high. So that's why understanding these variances is very important. So here's a standard cost example. So we might say the direct materials to produce this bat, we're making bats for baseball or something like that, or cricket. You have a standard quantity of 1 kilograms, and it's $25 per kilogram. So total standard cost is $25, but are we using 1 kilogram? Are we paying $25 per kilogram? We expect 2 hours of work at $20 per hour. We expect 2 labor hours of overhead based on the activity-based costing for overhead, or based on departmental rates, however we do it back in that older class. And then here's the standard allocation rate of overhead. That's why we're building onto this topic. You have to understand the previous overhead allocation methodologies. That's our total cost for the bat is $85. But any of this can go wrong. I'm not going to ask you to determine the standard cost in this class. This will be judgmental based on your business and whatever you're doing in your future career, and the company you work for. And you might go into determining a standard cost in a future cost accounting class. But for this class, I just want you to know what a standard cost is and how we can compare it and determine what's off. So you'll be given this information. This is just an idea of standard costing. Any questions regarding what standard costs are? No. Okay, hopefully this is all straightforward. Kind of just building off old concepts. So now I'm going to start going to the Google Sheets here because we're going to talk about cost variances. So how do we determine all the different cost variances? First, we have to determine, it's like an umbrella. We go from the top of the umbrella. What is the total cost variance? So what is our actual cost, total actual cost versus what we expected? This would also just be how off we are from a total budget perspective. If our actual cost is greater than our standard cost, it's unfavorable because we paid more than we expected. We can also call this standard cost, like an estimated cost. If actual is less, it's favorable because we spent less money than expected. So what do we do when we find out there's a cost variance? Well, first we have to prepare all this information, which we're going to learn today, and analyze it, which we're going to learn today. But then we're going to have to ask some questions. Like, why did the price go up? Why did it go down? And then we're going to have to determine what was the cause by asking those questions, and then take action. Do we need to reduce price? Do we need to incentivize workers better, et cetera? That's the managerial aspect of this. So actual cost minus standard cost is going to give us our variance. Standard cost. You're gonna have to memorize these formulas. That means actual quantity times actual price equals actual cost. And standard quantity times standard price equals standard cost. That makes sense, right? We take actual times actual to get actual. We take standard times standard to get standard. Does that make sense? That's the way I think about it, at least. I think that's self-explanatory, hopefully. Actual is what we used. Standard is what we're expecting. So we can make this easy if we give numbers to it. So let's say, I'm making this up to make it easier to visualize. Our actual quantity is 100. Our actual price is 10. We're going to, our actual cost will be 1,000. Our standard quantity is 90 and our standard price is 110. Our standard cost would have been 9,900. And then our variance would be here. You know, 11, sorry. So here we have a $10 positive favorable variance because our standard cost is lower. Oh, sorry, we have an unfavorable variance because our standard cost is lower than our actual cost. We paid more than we expected. But now we have to ask ourselves, what's causing it? We see all these movements, right? Is it the actual price? Well, it could be because the actual price was lower. We paid less than the standard price. So we should have a favorable variance there, but we used more. So now we know we used more actually, but our standard price, or we spent less. So now we need to actually quantify the variances between price and quantity. And so how we figure that out is some more formulas. We have price variance and quantity variance. And that's why I kind of call this an umbrella, right? We kind of keep going down. Price variance. And then we'll have quantity variance. So price variance is your actual quantity times your actual price here, less your actual quantity times your standard price. Price variance. So we have $100 price variance here. Negative $100. Why? Negative. We have it because the actual price we paid, oh, sorry, it should be positive 100. There we go. We paid $1 per unit less than the standard price. So we have a price variance of $100, positive, that's favorable. Our quantity variance, on the other hand, is actual quantity times standard price times standard price and standard quantity times standard price. we have a negative 110 quantity variance. That's us quantifying the value of us using 10 additional units to create our product. These two variances combined will give us our total variance. That's how we know we did it correctly. Right, these two equal. So I just do a check. This minus this should be 0. So now we have a little more detail on how we got our price variance and our quantity variances based on actual cost and standard cost. Any question there? This is why algebra is fundamental before this class, right? Understanding what we're doing is we're isolating the variables here. You can see here we're isolating what happens if we take out the standard price from the equation, and here we're isolating the actual quantity. So we're going to continue to do that for all of our different variances. Okay, questions, comments, concerns? Is this making sense? Can I get thumbs up, thumbs down if I'm making absolutely no sense? I got a few thumbs up.
I have a question.
Yes?
So basically, you can put it in any order.
You can put it in any order. You have to follow these exact equations. We can't put in any order. So each of these is its own equation.
Okay.
Yeah. Very explicit. So we can't, there's no creativity here. But there's a logic to it, and that's what I hope you all understand. We're just trying to isolate and figure out the different types of costs. Here's a different way to look at it if you're more of a narrative learner. So standard quantity is the quantity that should have been used for the actual good output. So we're just showing here that we're isolating the price. So actual quantity times the actual price is one bucket you can look at under the umbrella. You have the actual quantity times the standard price, and then the standard quantity times the standard price. So we can, on one side of the equation, calculate actual times actual. On the other, we multiply standard times standard. And in the middle, we multiply actual times standard. And then using the left buckets, we get the price variance. On the right buckets, we get the quantity variance, which we just calculated in the Google Sheets. This is just another way to look at it. This is on the slide going into more detail. This is just everything we just talked through in the Google Sheets. So that was just the concept of cost variances. So now we're going to go into another deep dive. We're going to do some more examples on how we can compute materials and labor variances. Please stop me if you don't understand this concept before we finish it, because the overhead variances are more complex. And so I want to make sure you kind of at least understand the basics of this before we go into the next step for overhead variances. So example 2. We have standard costs, material standard costs. Costs. We know our price. So we always have our price and our quantity standards. Our materials is price is $20 per pound. Direct labor price is $16 per hour. Quantity is 0.5 pounds. Hours is 1 hour. The total cost is here. $26. This information will all be given to you on your homework and quizzes. So now we get this next piece. we produced 3,500 clubs using 1,800 pounds of material. So these are our standards. Here's our actuals. Actuals, we used 1,800 pounds of material. We produced 3,500 club heads with it, which means we used how much? 3,500 divided by 1,800 pounds. It's kind of a 1.944 quantity. So we used, sorry, 3,500, put it the wrong way, 3,500, 1,800 divided by 3,500. So a little more than we were expecting, right? And we paid $21 per pound on the material. Our total cost was $10.08 per unit. And so they're asking, let's compute the variances. So we just go back to this. Exact same formula. We just bring it down here. Actual quantity used was 1,800. The actual price was $21 per pound. Our actual cost was $37,800. Our standard quantity would have been 0.5. We got that up here. Our standard price would have been 20. Oh, our standard price would have been 20. So this would be 0.5 times 3,500 clubs, and our standard price would have been 20. So we have a negative $2,800 variance. We spent $2,800 more than we expected. That's this 37,800. Here's our actual quantity times our actual price. Here's our standard times our standard price. And now we need to figure out these other variances, right? This automatically calculates. We find out that we have a $1,800 price variance just following this equation. And we find out that we have a negative $1,000 quantity variance. We can take a logical check here, and we can then do the check here to make sure the variances should equal 0. They do. And we'll use a logical check here. Did we use more materials than our standard? We did, right? 21, we used 21. We normally use, we used 0.51, but we normally use 0.5. So we should have a negative variance. We used too much. We also paid too much. Our price was $1 more than expected. And we can see that our price variance had a bigger impact on our variances than our quantity variance. And we just follow these equations: actual quantity times actual price, actual quantity times standard price, and then take the difference. Does it make sense? Any questions? Okay. Then we evaluate it. What went wrong here? Maybe we paid too much. Maybe our workers are new and they need to be trained better. We do the very similar format for labor variances. We call the labor variance instead of a, you can see here we call it a quantity variance. Here we call it an efficiency variance. These are just definitions and terms. They mean the same thing to me. Quantity and efficiency are just very similar. Efficiency is just the quantity of labor. So now they give us some labor information. So we can plug it in here. we paid an average of $16.50 to our workers. So we're paying more than our standard. We can see that. And they work 3,400 hours instead of on the 35 clubs. So we could do 3,400 divided by 3,500. So we actually worked per unit a little less. This is kind of our per unit amounts. So then we can just do this all over again for labor. Labor. So actual quantity. We'll figure this out here. Actual cost. We take our actual times our actual, right? Our actual cost is direct labor of 16.5. That's what we actually paid. I'm sorry, 16.5. Our actual quantity was this times, how many units did we make? This times, oh, it says here 3,400 hours. That's our 56,100. Our standard quantity or efficiency, if you want, this is standard now, is our 3,500 hours that was given to us. And our standard price is $16 per hour. Our variance is negative $100. Now we have to ask ourselves, is that coming from efficiency or is that coming from a rate? So, or price, right? So actual times actual is 56,100. Our actual quantity times our standard price is 55,400. So our price variance here is 1,700, sorry, negative 1,700. So we spent $1,700 more than we expected. This is because we paid an average higher rate. That could be coming from more overtime or not staffing correctly, staffing with more senior people. So we can figure that part out and take an action accordingly. The quantity variance or hours variance was actually positive, right? So our variance, we only have we have a positive $1,600 variance from increased efficiency, which we figured out by taking our actual quantity times our standard price and our standard quantity times our standard price and taking the difference. So our variance is $100 negative. So what we can learn from this is perhaps, this is what I would infer, is that perhaps we used a more skilled workforce. So we paid them higher hourly rate, slightly higher hourly rate, which led to them being more efficient. But overall, that led to a cost, a negative cost impact. Oh, and that's what they say here. Used highly paid skill force, which required less labor hours.